old when I first worked for Tokyo Mitsubishi as a European equity analyst. And when I look at the markets today, actually, there are a few similarities, unfortunately, between this time and that time. And we'll probably get into that at the second half of this presentation. But first of all, I want to focus a lot more on the reasons to be bullish. Oftentimes, we focus a lot on all of the things that are, risks in the market, things to be concerned about. And it is right that we do that, but we shouldn't lose sight of the broader picture. And I think, having that as our anchor point is an important place to be. So I'm going to run through the reasons why, if the market were to pull back here, the equity market specifically, then probably the right thing to do is to buy the dip. Okay. Here's a quick overview of equity markets, how they've performed recently. You can see the MSCI All Country World, so both global developed markets and also global emerging markets, powering to new highs post-COVID, and a slight difference between equal weighted stocks and capitalization weighted, where the largest companies have a bigger effect. So the larger companies have still been doing well there, but good bull trend in place. A nice recovery from the lows and making new highs. Fixed income, as we look at fixed income, I think the only line I would really pull out here is government bonds, the darker line. You can see that has sold off quite sharply this year. It's a reasonably big drawdown for investors in government bonds. And the reason, of course, for that is yields have been rising, and so the price has been falling. And the reason yields have been rising is because investors around the world see the return of reflation of economies. So there's a fine line between reflating an economy, where purchasing companies start to get pricing power, consumers go out and buy things once more, and an economy where there's inflation. So we might touch on a little bit of that at the moment, but reflating economies has been what's driving the equity market higher and the fixed income market a little bit lower there. We start with valuation. Valuation is always a good place to start. It really anchors you and helps you understand your expectations for what returns might be and what some of the paths might be. And as I've said before, our favored way to look at valuation is not just on a simple multiple basis, but to think about what is the earnings power of that broad basket of securities that you would invest in generally. And that's why we focus a lot on the trend earnings line that is put through here. You can see the earnings per share for the index at the bottom there. Now, as I said, the two scenarios we normally look at would be thinking about earnings reverting to the mean, recovering from COVID, and then growing at that long-term trend. But actually, there are reasons why we might focus a little bit more on case A at the moment. So case A is consensus expectations. It's what the market thinks earnings will be a year down the line, 2 years down the line, 3 years down the line. Now, ordinarily, they're a little bit bullish. They tend to come down. What happens is, as we get through the year, companies start to report, and whilst things are going well, they're often not going as well as analysts initially expected. So ordinarily, you see those numbers come down. However, when you're off the back of a recovery and things are, the business cycle is in your favor, you tend to get more beats than misses, and that means that actually, for once, there's good reason to expect that A scenario might be a little bit more likely. Just draw your attention to 2003, 4 and 5 there. You can see once earnings have cyclically dipped below their trend, they actually often make a trend in the recovery. The reason for that is, of course, corporations have cut costs, they've streamlined, they've thought about their profitability, they've cut unprofitable avenues. So when business comes back and demand comes back, they're leaner and more fit to fight. So you find that they have a supercharged earnings recovery. So again, that A path really reflects probably what's happened commonly through history when you get a recovery. So the valuation outlook is not too attractive. It's pretty pricey equity market, but I think the numbers to go off are probably that 4% for consensus. So not a huge amount to go for in terms of returns, but a lot of strength in the forecast there. So the second thing that you have to pair valuation with is the business cycle. And at the moment, we peg ourselves in this early upturn section. We're coming out of a depressed situation. We're seeing monetary conditions still very accommodative, improving there. We're seeing economic growth starting to pick up. I mean, we haven't printed any strong numbers yet, but as economies open and recover, that will happen. And we're seeing inflation trends, still remaining very low, but expectations start to pick up that a lot of firms will have pricing power in the future. And that generally leads you to equities as an asset class of choice, with actually a value tilt in there as well. So digging further into this business cycle, these are the PMIs, purchasing manager indices, that are done throughout most of the G20 countries there. Numbers are above 50. So even in this lockdown period, manufacturing has continued to go on. Economic activity has continued to go on. So that's indicative of growth in the underlying manufacturing economy. And of course, the bit that's really been hit hard is the services economy. That's the part where social distancing impacts the most. So lots of red on the board there, still indicating contraction, but the numbers starting to pick up and actually moving above 50 overall for February there. And very much people should expect that to move in positive territory and to get back into expansion. Economic surprises, this measures whether the economic data is generally better than people thought or worse than people thought. It's coming in better than people thought at the moment. That continues to be there, again, indicative of a business cycle which is supportive for profits, supportive for company earnings. And going back to this data point that I mentioned earlier, those consensus numbers, 85% of companies in the S&P beat earnings last quarter, and it's a similar number this quarter as well. So those earnings forecasts that people are using, not only there's some comfort that they're going to be delivered, actually a lot of companies are beating those. So potentially they could be a beat on that side as well. Just a bit of vaccines, and I think this data, I know it's been updated, there we go. UK up to about 30% of people vaccinated, US very quick behind there as well, 25% of people vaccinated. We're doing it, we're on course. Despite all of the skepticism we may have had a year ago about, can we develop a vaccine in a year and roll that out? It does seem that a year and a half that will have passed as we get into the summer, and we'll pretty much be vaccinated in the UK and the US. Europe's been a little bit fragmented in their approach. They haven't necessarily procured the right amount of vaccines here and there, but we'd expect them to follow suit in due course as well. So everything on track. And the data still indicates that even though we might get new strains, it does still protect you from the worst cases and the more severe outcomes. So even if people are still getting COVID, they get it in a mild way. So I think that's good news there too. Now, I just want to touch on some of the responses, excuse me, that institutions have had here. I've got this picture of Jerome Powell on the right-hand side. So he's the chairman of the Federal Reserve. He's in charge of dictating how much money is in the system. So he creates base money through their quantitative easing programs. And on the left, we've got the Secretary of the Treasury. So they dictate how much money the government will borrow. It used to be Steve Mnuchin, now it's Janet Yellen. For those of you that know, Janet Yellen used to have Jerome Powell's job. So it's a very sort of incestuous relationship here. But effectively, Janet Yellen is spending the money. So she's spending the money that the US doesn't have, and Jerome is printing it so that can happen. And this is actually a very, very powerful stimulus that is going into the system right now. And it's very hard to imagine this and to really comprehend the effect and the power it's going to have. I think the easiest way to think about it is, what is government spending as a percentage of GDP? So forget about taxation, really. What drives how big the government is how much does it spend? How many resources does it lay claim to in the economic system? And you can see in World War II, it got up to nearly 50%, so nearly half of all economic activity was dedicated to the war machine in World War II. Then you can see various social programs that drift that number up to sort of 35, where it was pretty steady there. But recently it's off the chart again, hit 55%. So half of the economic activity that's been going on in the US has been financed by the government. And of course, we've got the new stimulus bill that was voted through over the weekend. So this is going to have a huge effect on economic activity And of course, this is going to flow through into corporate earnings. So not only are we going to have people returning to work and the vaccine kind of stimulus, but we've got this in the background as well. And what does that mean for bond yields? Well, I said at the start, bond yields have come off as part of that reflation trade. I do think that's what it is at the moment. There are signs of base metals picking up in price, agricultural commodities picking up in price, but that is all to be expected as, once again, the economy starts producing things and making demands on various sectors of the economy to produce those goods and services. You've seen so far, this is the 30-year bond, so that's a pretty long bond there. It's recovered back above 2%, which compensates you for inflation, and it's really moved back to where it was pre-COVID. And you can see even then it was in a pretty depressed state. So with the strength of the activity from government stimulus and from the vaccines, there's definitely scope for this to move higher. We start to get into a lot of questions about when does this affect growth? When does this start to pricing inflation? I think that would be the subject of another hour-long webinar, so we'll leave that there for now. But equities are the vehicle of choice here. They'll benefit from the earnings that come through, and they will avoid some of the drawdowns from yields rising there. I mean, if we put this together, we've got the vaccines that spur the reopening of the service economy, which means that consumer spending rebounds, and potentially quite strongly. That lots of people have maintained their sources of incomes because of government programs through this period, especially in the developed world, and they're itching to get out there and go on holiday and spend that money on things, on activities. We've got the government spending, really driving growth at a, I wouldn't say unprecedented, because it's kind of at World War II levels. And then monetary conditions remain cheap. Even though yields have moved up, they've moved up to where they were pre-COVID, and they were cheap then anyway. So financing is cheap for corporates. Credit spreads are low. We can go through that as well. So financing is there. And there is a huge CapEx surge that is looking to go ahead now. The energy transition away from oil towards renewable energy, solar power, nuclear power, wind power, hydro, electric vehicles, electrification of all of the petrol pump stations and moving to electric vehicles. This is a massive investment in capital equipment for rejigging effectively the way the economy works. Huge amounts of money need to go into building that out. And then let's not forget, we've all used Zoom a lot more. We've all used technology, Microsoft Teams. All these school children have learned new tricks. The productivity gains that we're going to get from the adoption of tech that we've seen. Now, technology stocks have had a really, really strong run. And part of that is because people have brought forward changes that they were making. So there's new services and systems that are out there that weren't there before, and they've been deployed at scale on a quick level. And remember, what drives productivity? It's not the discovery of technology, it's the deployment of technology. And that's what we've had. So huge scope for productivity gains there. Unemployment, we do have people that are out of work, and there's scope for them to be put back to work into the system. So as unemployment starts to fall, that gives you spare capacity, so you can use that up. And all of this is really going to drive corporate cash flows to be really very, very strong. Earnings should be beating, and that flows through to equity holders. And central banks will do everything they can to maintain low, stable yields. Yes, some of this is going to cause a tick up in inflation. What they're going to say is that is wanted, it's desirable. They're going to say it's also transitionary. Some of it is just, it's the effect of restarting. So whilst it's above trend now, it's just making up for past points of deflation. There's a lot of curve control in order to keep things orderly, and we expect them to be on that. So so dips in equities do come along. The most likely cause of a dip in equities in risk assets is some kind of pickup in inflation, where the market says, will the Federal Reserve have to raise interest rates? Will they have to take away some of the stimulus? But the way we look at it is that they're not going to want to do that. It's too early in the recovery. They don't want to put it at risk. And they've already stated publicly that they're going to try and look through inflation. So we expect them to act at their word effectively. I think it would be very difficult and painful for them to do otherwise. So that remains the central outlook there. How am I doing for time? I think I've got time to go carry on, Mark. Is that, keep going? Yeah, keep going. I want to talk a bit about bubbles, because one of the things that's happened is a huge amount of money in the system, and in the US in particular, the money supply has expanded by about 30%. This is developed markets. So two lines here. One is the growth index. So those stocks where earnings are very far off in the future, or where maybe there's no earnings today, but the business model is expected to be profitable sometime in the future. Think about Tesla as a good example of that kind of stock. And then the value index is, stocks that are, their value is here and now. They tend to be higher dividend payers. Think about banks, I guess you can see there's a good example there. Huge discrepancy between growth and value. Now, this is not a problem if it's driven by earnings and one sector is doing better and out earning the other sector, but it can be a problem if it's driven by changes in valuation. And what we've seen is the valuation of those two sectors. So the growth index, the orange, before we got into COVID, back in January 2020, it traded at about 15 times EV to EBITDA. So think of EV as the value of the company, EBITDA as the cash flows that company produces. So multiple of the cash flows. 15 times is higher than it's been historically, but there's good growth here and they were delivering. It's now moved to 20 times. So a significant re-rating, and the earnings are there. So the earnings haven't disappeared for the growth stocks. Whereas if you look at the value index, it hasn't really moved so much. It's moved from 9 times up to, say, 10 times. So a lot of the outperformance of the growth part of the market has been due to the fact that people just want to pay more. Okay. What causes a bubble? Bubbles, they've happened all through time and history. You can see the tulip bubble there, all sorts of different bubbles that have been put up there. They tend to have, rapidly increasing prices, and then the bubble deflates and it comes out. And they're really caused by money chasing assets. Now, as money is put into the system, if it chases goods and services, people try and spend it on consumption, then you get consumer price inflation. But oftentimes that doesn't happen. People tend to take that money, they keep their lifestyle the same, and that money chases capital instead. Now, the amount of capital stock in the world it doesn't change that easy. You can't easily just build a new factory. So if you have more money chasing limited capital, you tend to bid up the price of capital and you get these bubbles that come through. So that's the dynamic by which you get it. Now, bubbles they're scary things. People think about losing a lot of money. In the initial bubble stage, obviously a lot of people are making a lot of money, but when they dissipate and deflate, then you can potentially lose a lot of money. So it's worth looking at the 2000 bubble. As I said at the start, there's some things that rhyme with my career when I started there, to see how that plays out. So the NASDAQ here is the technology stock, the poster child of the tech boom. You can see it rising 140 odd percent between 99 to 2000, May 2000 there. And then crashing back down to earth and deflating over the next 2-3 years. But I want to point out there's a lot of companies that actually did quite well in this backdrop. So the S&P mid cap and the S&P small cap, they're US smaller companies and mid-sized companies. They continued to do quite well, even as the technology bubble deflated. And then in the FTSE as well, the FTSE mid cap, that continued to do quite well, even as the bubble deflated. Because what you get is you get a lot of stocks that get left behind. The story stocks, the ones that capture people's imaginations, they're the ones that really race ahead and become disconnected from reality. Other stocks can, hold up. And at the moment, you're seeing things like, Unilever, which is, not going anywhere and is quite depressed. Good example of that. So you can make money even when a bubble deflates. This is the GDP for the US economy, and the bit that is square boxed there is the implosion of the tech bubble. And so another point here is that a bubble imploding doesn't necessarily cause a severe recession. It can deflate on its own and the economy can kind of chug on. It means that you stop doing the bubble stuff. In the tech boom, this was stopping building fiber optic cable, stopping buying 3G licenses for insane amounts of money. But I want to point out that economic growth didn't go negative. It stayed at zero through this recession. So it was a slowdown in growth below trend, but it didn't go negative. So just be aware of that. Now, so I showed those charts at the start. But it really comes alive, I think, if you look at individual stocks. So, okay, the growth stocks have moved higher, but what does that mean? What are people actually thinking about? And I've picked two examples here. So this first one is a European stock. It's ASML, and they make what's called the lithography devices for the semiconductor industry. So if you're going to make semiconductor wafers, what you're going to do is you're going to take your silicone wafer, and then you're going to use lasers to etch down into the wafer, where you're then going to lay the metals that are going to be the semiconductor conducting pieces. So ASML is one of two companies or three companies that make those lithography devices. So it's hugely capital intensive. They sell to people who are going to spend billions and billions of dollars on new fabrication plants. And they only do that when they think pricing is good. Okay, so what tends to happen is everybody builds out at the same time when prices are strong. And then as everything comes on stream, because it takes a year or two for these devices to come on stream and a new factory to get producing, then the market is then flooded with chips. The chip price falls, and then the semiconductor manufacturers say, oh, we spent too much money. And then so ASML is cyclical. There are times when it does really well, and there are times when it has very little demand. Okay, you can see the orange line here is the earnings per share, and you can see how it's grown. It's grown about 20%. Okay, so and I've stopped the price chart there in October, but we've run forward the earnings, so you can see nothing's changed in the way people think this company is going to earn. Nothing's changed with expectations. It's the same company. It's going to do the same thing. The valuation you can see at the bottom, so that's how much people are paying for a unit of earnings. It's moved from 20 times to 30 times. Okay, and at the moment it's going through a positive cycle where lots of people are in demand for their product. But I just want to play forward now what happens to the share price and also what happens to the valuation. You can see COVID causing a little dip there. Right. So the share price has done amazingly well. Okay, and it's obviously part of this growth area of the market. But why has the share price done well? It hasn't done well because people think it's going to earn more money. In fact, expectations are pretty much unchanged. People still expect this company to grow earnings at 20%. What has changed is rather than paying 30 times earnings, people are now paying 45 times earnings. And of course, that means that you're just paying more for the same investment. And if you pay a higher price, and nothing else has changed, your forward-looking returns come down. Let's look at PayPal. PayPal's a different sector, so it's the financial sector. Here we're looking at a company which is facilitating online transactions. All right. Again, growth rates prove similar, so it's been growing at 20%. In 2016-17, it was growing at 20%. In 2020-21, it's still growing at 20%. Nothing has changed on how people expect this company to grow. But look at the valuation. It's moved from 20 times to 30 times, maybe justifiable because maybe it was cheap before. Maybe 30 times is the right number. But if we play this forwards, we can see what happens to this, and a similar thing happens. Again, the price rises strongly, but it's driven not by the change in earnings, it's driven purely by the valuation moving higher. Now, if you buy this stock on 35 times multiple, that is a very different investment proposition than buying it on a 65 times multiple. Okay, your future returns are now a lot lower for this particular stock. So there are pockets of the market where people have just been willing to pay twice the price for the same growth that they used to pay. And equally, there are also pockets of the market that have been neglected and have been left behind, just as there was in the 2000 bubble. This is just a quick scatter graph of developed markets here, where on the bottom axis, left to right, you've got long-term earnings per share growth. So looking out past COVID, when things have stabilized, to what is the growth in year 3 and year 4? So 2023 to 2024 there. And then the y-axis, the PE ratio, is how much you're paying for that unit of earnings, and it's based on that 2023 number, so getting rid of COVID as well. So looking through COVID, and you can see there are a lot of stocks where they've just drifted higher, And there's a lot of stocks now where that PE ratio is above 30 times. This is messy data, so there's some outliers here. I've labeled two there that are property companies, for example, that this doesn't really capture very well. But that's the market generally. Now, my point is, you don't have to invest in the bubble areas. If you want to, you can invest in the area that's sensible, where people are still paying sensible valuation multiple for a reasonable amount of growth, 10 to 20% growth there, but keeping that valuation multiple under 30 times. So I would argue that there is a bubble going on. Definitely, we see that in the individual names, as I've shown you, and we see it in the indices, that you can mitigate the effects of a bubble by investing sensibly and not getting too caught up in the stories and paying the right amount for growth. And that it doesn't necessarily mean that as a bubble deflates that causes a recession as such. I mean, it might cause a slowdown in growth in the places where those businesses are investing, but you can still do okay in that situation. And that's just the names that we own in our portfolio, but less interesting. I think 1929 was the time when Irving Fisher had his famous quote, "Their stock prices look like they've reached a permanently high plateau." I think in all likelihood, there is a bubble. Okay, when that bubble deflates, some stocks will still do well. And if you've recognized it and avoided it and focused on quality companies that trade at a reasonable price, then you can still have good returns from here. And that's what we do. So my advice is don't chase the bubble and buy the dip if we get the dip. And with that, have we got any questions, Mark?
Thanks very much, Phil. That was very insightful. I think just on housekeeping, any questions can come through the chat. You can raise your hand, and then we can give the floor to you. I just wanted to touch on one or two things to get the questions going. Phil, you touched on it, and perhaps start with the last one first. Advising clients at the moment, you had the slide of value versus growth stocks in the equity markets. If you were advising clients, which trend would you be following, the growth or the value?
I would, if those are your only two options available, and in that blunt scenario, then I would have more weighted on the value than the growth, because as I said, some of those growth stocks are very expensive, and even if things pan out the way people think they are, you're not going to get your 7-8% that you would normally get from equities. You're probably going to get long-term returns of 4%, let's say. Whereas in the value area, you stand a chance of getting your 7 to 8%.
Okay, and the second question, and there's already questions coming through. The second question that I have, you touched on it briefly, with the rise in commodities, the uptick in commodities. There's been whispers that and views expressed, perhaps not whispers, that we are going back into a super cycle for commodity prices. Do you think that is so? And if so, what effect do you think that will have? And I'm speaking topically, from sitting in the emerging market type of scenario, for economies that are based on commodities. What do you think the effect of that will be?
Yeah, I've got a lot of sympathy with that view of a super cycle. If you think about the amount of investment that has to go into basically electrifying everything, taking every single car off the road and replacing it with an electric car. Think of the batteries that's needed. Think of all the electric components in the car. Think of your house charging statement. Think of your service garages that need all these plug-in places. And think of all the electricity we've got to generate through green renewables. It's just an immense amount of investment, and it definitely can't be done in 1 or 2 years. And it's going to require more resources to build that out. Now, clearly we can recycle some things. Steel, for example, is pretty much all recycled, but we're going to need a lot of new stuff as well. And that should be supportive for commodities. And then that should be positive for I guess, emerging market currencies as well, and their trade flows.
Okay, then flowing from that, the question has come through. If commodities are entering a new bull cycle, which ones do you prefer?
Yeah, so I'm not a commodities expert, and we don't have that many commodity focused investment teams at Sanlam. Having said that, I did spend some time looking at a couple of mining stocks recently. I think copper's an interesting thing. So if you're going to invest in mining, and mining is a very tricky business to do. So a lot of them, the management teams aren't necessarily that great. They tend to, you know, invest at the wrong times, etc. But I think if you decide you're in a super cycle, then you've got a good tailwind to your back. So, you know, it's worth considering some exposure in the portfolio. We've definitely considered it, even though we haven't acted on it. I think, yeah, copper is a big part of that electrification, and my understanding of the, you know, the supply constraints is that it's attractive metal from that side as well. And you sometimes get some gold thrown in for free if you get a copper miner.
Next question: with rates so low and correlations between equities and bonds increasing, how may investors protect themselves against equity corrections or crashes into the next cycle? I think you did touch on that, but perhaps just a direct question.
This is one of the biggest challenges that that investors face, is how to craft portfolios with that insurance capability that government bonds traditionally played. We've taken our government bond weight down to 0. And one of the reasons we did that was we didn't think that they were going to be negatively correlated with equities anymore. We thought that the protection they give you on a pullback and a shock just wasn't going to be enough at the 0 bound. So we saw that as a cap on the upside potential for them, which meant we had to look elsewhere. There aren't any miracle solutions for this. It's just a tough problem. What you can do is you can invest in shorter dated credit, so still get paid a return from credit, because the economic cycle is still strong, so credit spreads shouldn't really blow out too much. And if you're invested in short dated paper, 2 years, 3 years with a sort of ladder portfolio, then that can reduce your volatility of your portfolio. But I think ultimately you just have to accept the fact that your portfolio is going to be more volatile, and you have to just wear it. You have to take a longer time horizon view, and you have to be willing to look through it. So you need to steel yourself for, if you do get a pullback, think about how you're going to react emotionally. Think about, what you're going to buy. I think that's the most important starting point. Don't think about how am I going to panic and sell. Think about, okay, if things were to come back, what risk budget have I put aside ready to be invested? And that's where you want to be right now. So you've got a small pocket that you can put into risk assets if they do pull back.
Thanks, Phil. Phil, there's a few questions coming through on inflation, and I'm just going to pick one of the lines that I think sums up the question. Is the markets are already getting cold on rising inflation fears, but the Fed and Treasury still maintains that they don't see runaway inflation. As markets sentiment diverges from the Fed's, how should investors position themselves? I think that there's been a couple of questions that are coming through on inflation. You did touch on it briefly earlier in your presentation. Where do you see this going?
Yeah, so inflation is nasty for risk assets because it potentially ends the party. So inflation is the one thing that forces the central banks to raise interest rates, and then that would trigger a recession. Now, they're going to be very reluctant to do that. And actually, the amount of debt that's out there means it's very hard for them to do that. So our base case is going to be that they won't do that. Inflation will run higher. People will get spooked thinking that the Federal Reserve is going to raise rates, but then they'll come out and they'll calm everybody down. They'll say, no, it's only temporary. We're going to look through it. This is what they're going to say is what they're going to say. It's not anchored in any sort of belief system or truth. It's just they're going to say what they have to say. I guess that's a fancy way of saying they're going to lie, but yeah, they're going to lie. So longer term, it does mean that there is a risk of, which hasn't been there before, I would say, but there's a risk of structurally higher inflation, and inflation that is seen as out of control. Now I think we're a few years off that. It takes time for things to percolate through. First of all, as you start to put people back to work, you've got spare capacity, so that can ease some of the strains. You can start to dig new mines, you can start to expand production, especially for some of these industries that haven't really invested for a while. So I think there's a lot that they can do in the short term there. But if we keep pushing with interest rates where they are, and as those animal spirits pick up, I think 2 years down the line, that becomes a bigger risk. The unfortunate thing about inflation is there is no way to really time it. It's a psychological phenomenon, and it causes immense uncertainty in markets, and it means that people can't really plan their businesses properly. So entrepreneurs make mistakes, and it means you're in for a hell of a rough ride and more volatility. And I think that's partly why you've seen equity volatility remain about 20%. I mean, it's up from the 10% that it was, back a few years ago. And even though we've seen prices move higher, we've seen volatility remain quite high. So you see that in the market as a persistent effect. I'm not sure if I've answered the question there, but
yeah, I think that's great. Well, we're running out of time. I'm just mindful of that, and we probably could speak to you all day. So what I want to do is just to our attendees from all over Africa and beyond, if there are any questions that you have for Phil, you're welcome to email me. I think our email is in the invitation that was sent, and then I can flick those on to Phil. Phil, if you're happy to respond to those. We are a little bit pushed for time, but yeah, Phil, once again, it's been fantastic. Really appreciate it. And thank you everyone for attending, and stay tuned for further webinars that we'll host with Phil and other speakers. So from me here in Naivasha in Kenya, I want to say thank you very much for attending, and Phil, thank you very much once again. Very insightful.
Thanks for having me, Mark.